Kicking off the trading week with a little bit of risk aversion. Live from New York City this morning. Good morning, good morning. Equity futures down about 0.8%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, we begin with the big issue, entering the final stretch of 2022.
There's going to be a lot of data.
We're obviously waiting for Powell on Wednesday.
This month's employment report.
CPI day.
The Fed meeting.
We've got this twin terror events.
I think it's going to come down to inflation and how the Fed reacts to all of these numbers.
On December 13th and 14th. I can't remember a time when the CPI and FOMC were on top of each other like this.
There's not likely to be a data point that's going to deviate one way or another.
50 basis points is very well telegraphed and priced in.
I do think we're in for a period of choppiness.
The volatility is going to continue.
This recovery isn't going to be easy until we see some progress.
There's going to be ebbs and flows in financial conditions.
We're all subject to the data.
Let's get the show started. Joining us now is John Hancock's Matt Miskin and Greg Staples of DWS. Matt, first to you. What a rally off the lows we've seen of about 20% on the Euro Stoxx 50, more than 10% on the S&P 500. Are you pushing back against that?
It's a lot of it driven from the China reopening narrative that hasn't materialized. In fact, it's gone the complete opposite direction. You look at oil prices, they've all obviously rolled over here. We're lower than where we started the year. Copper's rolled over. Chinese equities are rolled over. Yet European stocks, they seem untouched. They seem almost invincible right now. And the euro is even rallying today in a risk-off environment. Used to be the dollar was the risk-off currency. So you're seeing, I think, as we go into the holidays, European equities are kind of the top, or the present du jour, if you will, the hot ticket item. But we're looking to fade some of this risk rally. We think the reopening news is actually reversing here as COVID is becoming more of an issue in China. Growth is slowing, and central banks are still raising rates into slowing economic environment, which we think is going to be felt further into 2023.
Matt, underpinning any view for 2023, you've got to have a working assumption on what you think happens with China. It's amazing to me that we seem to have more confidence around the Federal Reserve and the trajectory of the US economy than we do what's going to happen with China. And it just seems to me that people are willing to push it to one side and say, don't know, but I'll still make a call for 23. Can you make a call for 2023, Matt, without having a decent idea of what China's going to do here?
Well, you have to basically premise it on, are they going to stimulate even more? Because really, COVID, in terms of the U.S. and globally, we snap back so quickly out of it because we did so much stimulus. And if you look at China right now, how are they going to do that? They're going to have to devalue their currency significantly if they're going to issue more debt, if they're going to do more stimulus, cut interest rates as the rest of the world tightens. And if you're going to devalue the currency, you can see capital outflows, which is then going to result in still weaker growth out of China. So we wouldn't pin that down as a strong point regardless. In the global economy, we think reopening will ebb and flow. But nonetheless, the underlying trajectory of the economy structurally is going to be driven from central banks raising rates, which we haven't even stopped yet.
Greg, how are you processing the events over the weekend in China?
I think it's a little bit early to tell, obviously. There might be a binary outcome between a strong repression like we had in Tiananmen Square so many decades ago, as well, or perhaps just letting some of the attention erode from the marketplace at all. I think that they're still trying to figure that one out overall. As far as the internal U.S. data is concerned, I think it's going to be very important to hear what Powell says on Wednesday. What we're seeing now, I think, is a reprise of that risk rally and rates rally we saw in July and August when the market sensed a false pivot and rallied very hard. It got in the way of the Fed's project as they were trying to restrict monetary conditions, set it back a couple of months. I think we'll see the same thing happening now. We've seen a 40 basis point rally in IG spreads, a 100 basis point rally in high yield spreads, and I think Powell is probably going to push back against that on a speech on Wednesday. Let people know that they're really hawkish and they're going to stick through this until they really get inflation under control.
Great. Any reason, though, to believe that it is different this time, comparing the dynamics, the backdrop of now between what happened back in the summer?
We are seeing some early indications that the market is slowing. Obviously, a lot of headlines in terms of layoffs, even though most of that has been in the tech space. And it's not what I would call the demand for tech labor that's been pushing inflation pressures higher. It's more at the lower end of the economic spectrum, your healthcare workers, your restaurant workers, your retail workers, and it's still very, very strong there. But overall, you are starting to see early indications, and we might get confirmation of that later in the week when you, again, look at initial jobless claims on Thursday, and of course, the very, very important non-farm payrolls number on Friday could signal some slowing that's taking place there.
A big week ahead, big month ahead as well. On December 2nd, we get payrolls this Friday. Then beyond that, it's CPI on December 13th. And Katie Lyons, December 14th, the Federal Reserve. Then I guess it's kind of year over, isn't it, Katie?
Yeah, I guess maybe not officially, but for this market, it might as well be. 5 actual trading weeks left in this year, and this week in particular is going to be a big one. As you were just discussing, we hear from the chairman of the Federal Reserve, Jerome Powell, on Wednesday, where importantly, we also are going to get JOLTS data. So how many job openings are there still in this U.S. economy? And of course, that will be ahead of other data we get throughout the week, including PCE deflator, initial jobless claims, and then ultimately that payrolls report on Friday, which we're expecting is going to show about 200,000 jobs added in terms of non-farm payrolls. So will we see the softening in the labor market that the Fed is trying to engineer? And of course, all of that ahead of a big second week of December. And what we expect at that December meeting from the Federal Reserve is a hike of 50 basis points. That is what the market is pricing in. Then another hike of at least 25 in February, potentially another in March. The ultimate terminal rate that the market is betting on at the moment is 5.25%. What's interesting is while that terminal rate expectation has moved higher, equities also have rallied. As you all were just discussing, a lot of faith has been put into the idea that that is it. The Fed isn't going to have to go any farther than that as inflation is cooling. But how much upside risk to that terminal rate is there really? It'll be interesting to hear the chairman's comments around that on Wednesday. Does he beat the drum as other federal officials have time and again, reiterating that the inflation fight isn't over, that they're going to keep going until the fight is won, and they see a trend of inflation moving lower back toward their target? And on the subject of inflation, of course, that CPI data coming up on the 13th, we know those prints have the potential to move the market in a material way in either direction. When it has come in hot above expectations, we have seen serious declines in equities. But last month, or this month rather, the print from the month prior on November 10th, we saw a 3% rally in the 30 minutes after that data came in cooler than expected. So my question, John, is can you get a downside surprise, the right kind of downside surprise, 2 months in a row? And does that make a trend for this Federal Reserve? Katie Lyons, thank you. Setting up the Federal Reserve and the data still to come. Matt Miskin, let's go to the Fed. If you go to the projection materials from the September meeting, open that up, go through the SEP and look at the shift on rates for 2023. They went from 380 to 460. Big jump, Matt. The chairman's teed up another move, potentially of the same size. How much scope do you think is there for pushing that rate much higher from here?
Not much at all, frankly. We think that basically the bond market's right and that we see another 50 basis point rate hike in December. You know, you look through the Fed minutes and the word slow came up 24 times, slow or slowing. Whether it was the jobs data, the inflation data, and that was before the CPI report. So, you know, we think they are going to slow down. They're going to slow their roll with a 50 basis point rate hike in December. We think 25 in the early 2023, but actually they might be overly hawkish in terms of how it's being priced in. But we forget about the balance sheet sometimes. You know, when we do all this work on what are they going to do for rates. The balance sheet is now running at $95 billion a month coming off. November was the first month of that. And we did 75 basis points and 95 billion off the balance sheet. That is one of the most tightening we've seen in decades of this cycle. And that is going to be felt well into next year. So the Fed's already done a lot of the work they've needed to do. We think inflation comes down, growth comes down with it. But fixed income looks really good here as we go into 2023.
Matt, given what's happening with the balance sheet, how much signal can I take from the yield curve? A number of years ago, if I said 2s, 10s was flattening, we're about to get inversion, I'd get pushback. I'd say, yeah, but the balance sheet this, the balance sheet that. 2s, 10s right now is negative 80 basis points. How much signal is there?
We think there's a lot of signal, and we think it's the most underappreciated. So now all of a sudden we've been following this forever. And now, you know, we're throwing it out because markets have held in okay. But if anything, the 10-year should be higher, all things considered, because the Fed is unwinding its balance sheet. So market forces are pushing down that 10-year even more, given that the Fed is unraveling at $95 billion a month. So if anything, you should look at it more, given the long end is compressing so much and the short end is so elevated.
What's the signal, Greg, from 2s, 10s at negative 78 basis points this morning?
I think right now we respect that signal. It means that the market is perceiving that the Fed is going to have to over-tighten and really send this economy into recession. Long term, though, we think an inverted yield curve is really not an equilibrium. An upwardly sloped yield curve is the more normal, if nothing else, because you want to get a term premium into the yield curve overall. And moreover, if you're buying the 10-year right now at a 360, 370 yield, you're looking at financing that at 4.25, a negative 60 basis points of carry. For fast money, if you believe the Fed's going to be on hold through 2023, that's going to be extremely painful. So we do see a re-steepening of the yield curve in 2023. It's a little bit early there, but I think that's one of the big trades, and if you get into it, you're going to make a lot of money.
To be clear, though, Greg, that steepening led by a 10-year yield climbing and not a 2-year yield falling?
Exactly. I think that the 2-year yield, as we get deeper into 2023, is going to start to anticipate Fed easing in 2024. Think a mid-year or third quarter as the Fed starts to signal the true pivot. And then on the long end, you're still seeing inflation running at 3 to 4%, as well as some of the impacts to QT, leading to a 10-year Treasury north of 4% for much of 23.
Matt, final word on that.
Yeah, we think the Fed is going to be cutting at the back half of next year. Recession's only starting. We think it actually begins at the start of the year. You're seeing these layoffs. You're seeing the jobs market weaken. Job support Friday is going to be huge. But if that weakens, the Fed's going to be cutting sooner than we think.
It's a crazy time, isn't it? Greg, you said it in your notes. We're discounting a recession and pricing in a recovery before we've even had the recession.
Yes, it's a strange time. The markets tend to do that. And again, that's why we've had the pivot rally in the summer. Powell pushed back very hard in Jackson Hole, and in his press conference after the November meeting, we're rallying again. That's why I expect him to push back, not quite as hard, but to say, hey, you might be getting a little bit too enthusiastic here in the rates market, in the credit market, even in the equity market.
Straight from the script of the last Fed meeting, maybe. Equity futures down about 0.8% this morning. Matt Miskin, Greg Staples sticking with us. Coming up on this program, unrest growing in China.
We're entering 2023 when there's just so many unanswerable questions. And China, which has been a pillar of global growth for the last 20 years, we just don't know where this is going.
That conversation up next.
As long as we're seeing the ongoing COVID zero policy, we're not going to see, much of a stabilization in domestic demand.
At this point, it looks like that a rapid opening of the economy will be worse for China's growth.
The outperformance that we have seen in the Greater China region could be capped in the very near term.
The next few months are clearly going to be challenging.
The biggest problem now, of course, is in the labor market.
The domestic challenges are huge.
They are massive. Protests spreading across China, citizens pushing back against the nation's COVID zero policy, some calling on President Xi Jinping to step down. Goldman expecting the headwinds to continue, writing the following: the central government may soon need to choose between more lockdowns and more COVID outbreaks. The current situation imposes further downside risk to our below consensus Q4 forecast. Our 30% subjective probability of reopening before QT next year includes some chance of a forced and disorderly exit. Joining us now, team coverage here at Bloomberg, Alan Wan in Shanghai and Damien Sessa here in New York. Alan, can we start with you just describing how different the events of the weekend are compared to what we may have seen in previous demonstrations over the last couple of years?
Oh, sure. I mean, I've actually witnessed a few demonstrations in the past, back in 2011 at the Jasmine Revolution. And even last year, I went to Shenzhen to cover the Evergrande protests. But those protests were very targeted, very limited. And the protest over the weekend was huge. There were several thousand people marching on Wulamuchi Road, which is a very fashionable area of the French Concession. Several thousand people, a couple thousand people, young and old. They were calling for everything from the end of COVID zero to the release of prisoners who have been detained a couple days earlier because after a peaceful vigil, and even calling for political change. And they were they'd be confronted by police. I mean, they were talking about hundreds of police who were busted to confront these protesters. And what I gotta say was really tense and chaotic. Not particularly violent, but there were episodes of violence. basically, I saw police haul away a couple of protesters. One of my friends is a cameraman for BBC. He was detained, and he was allegedly assaulted as well. So this is definitely not something that I've experienced in my 13 years in Shanghai.
Alan, can you help us also understand the potential for a policy shift off the back of these events over the weekend? It's a big conversation in markets whether we will get that shift away from COVID zero because of something like this. What's your reading of that situation?
Right. I think there are basically the government has two options, right? First, it could relax. Well, I mean, a lot of people have been expecting. This is the reason why we've had a rally in the markets over the last few weeks. Expectations that we're going to have an early exit from COVID zero, possibly after the National People's Congress in March, and that has fueled a rally. But given the recent upsurge in cases, that's going to make it quite difficult. But given the fact that we've had some massive protests over the last few days, not only in Shanghai but in Beijing and Wuhan, I mean, it's spread nationwide. I mean, this could put pressure on the government to sort of accelerate, an exit from COVID zero. That said, the government hasn't really said much about it so far. But the Communist newspaper, the People's Daily, said that they're planning to stick to COVID zero. So there's a chance that the government will just double down on COVID zero. Yeah. And that's even more concerning given the fact that earlier this month, the government unveiled these guidelines to loosen the rules. And now there's been sort of a reversion, from all of that. So there are these two options, and we're not quite sure which one is going to win out. So we're just going to have to wait and see.
Given the vaccine coverage and vaccine efficacy in China, it's a choice between more lockdowns or more COVID outbreaks, Damien. That's what Goldman is indicating. Goldman also raising this, Damien, and I thought this line was interesting. The chance of a forced and disorderly exit from COVID zero. Damien, what do you think that looks like?
Well, I mean, look, for me, I mean, I have to agree with a lot of things Alan, Tom, and a lot of our people on the ground in China are seeing and saying. But for me, I mean, President Xi does not respond well to a forced response. And I just don't see that happening again this time. I think you have to look to Hong Kong in 2019 for a comparable as to what we're witnessing today. What's interesting about Goldman Sachs is they're saying, yes, there's only a 30% probability they're going to exit early being in the first quarter, but there's a 60% probability they're going to exit in the second quarter. I think you have to even push that back. I mean, look, this is not going to, we all knew it was going to take time for COVID zero to unwind. Now it's going to be, in my opinion, that much longer. I just don't see Beijing responding that well to any forced measures.
So base case for growth next year, Damien, for you and the team looking at China at the moment?
Four handle for the year. Yeah. I think that's really where the market is. I mean, we're looking at 3.9% in the fourth quarter of this year. I think people expect it to rebound mostly in the second half. It's going to be a tale of two halves in 2023, Jonathan, as was 2022, with I think rosier times ahead as we push into push into the autumn months. But I think where we are right now, 720 on dollar yuan. I mean, all the way back, it was at 705 just a few weeks ago. We were down 1.6% overnight. China, the Hang Seng China Financial Enterprises Index was off as much as 4.5%. The most interesting thing, 286 on the China 10-year. You got to watch that yield. It's at the highest all year, okay? And 290 is resistance. If we go through that, I mean, foreign investors, only 9.4% of foreigners own CGBs or were holders of CGBs as of the end of August, Jonathan. That's the lowest in 25 months.
Damien, great coverage as always. And to you, Alan, thank you for being with us as well late into your evening. We appreciate it. Apple this morning, a stock to watch. The stock is down by more than 2%. Our latest reporting here at Bloomberg suggesting that the turmoil at Apple's key manufacturing hub in China likely to result in a production shortfall of close to 6 million iPhone Pro units this year. That's a lot. One thing we've also heard from the likes of Jefferies is an estimate around Apple's revenue forecast. They said a number of weeks ago that they estimate the impact to be about $1 billion of revenue and about 1 cent in EPS per week of lockdown. Now, Matt Miskin, these numbers are big. And I think for me, the question now, Matt, is whether the bigger concern for you off the back of events in China is a demand side story or a supply side one. Which one is it?
I think it's more demand side. You know, China has been such a huge incremental growth engine. And if they're slow, I mean, if they're not reopening, then that's going to change the global economic output and total ecosystem is impacted. Supply side is going to be an issue and earnings are going to come down. I mean, And the fact is, we're trading at 17, 18 times earnings on a price to earnings ratio basis, and earnings estimates are only 4% off all-time highs. We see that coming down more into 2023. But as we get through Thanksgiving in the United States, the thing, in terms of markets that we're most grateful for is there is an alternative to stocks now because bond yields are so elevated. So there's income to be generated as we go into 2023. We would push more into the fixed income side of markets, look for high quality income because there's risk to the earnings downside, whether it's Apple or some of the other big companies out there that have this global supply chains and global demand that they need. Is going to probably be weaker into 2023.
Matt, outside of the front end of the yield curve in the Treasury market, where is that opportunity in fixed income?
Yeah, I mean, we're right in the intermediate. We're looking to go longer as we get further into 2023. But right now, investment grade corporate bonds are trading about 90 cents on the dollar. They were down to 85 cents. That's the lowest since 2008. We're looking for 2008 type discounts in bonds. High yield is not there, but higher quality bonds have seen those kind of drawdowns that they saw in 08 type levels in the corporate market, at least. We think that's a good opportunity into 2023.
Greg, do you agree? Final word.
I'd just be a little bit more in the inner on the yield curve. We think 2s and 5s are quite attractive. You're seeing yields that are available north of 5%. I'd be a little bit cautious as you go further out, only because of the fact that, again, IG spreads have rallied so much, 10-year rates have rallied so much, 75 basis points within the past month. I think it's well ahead of itself, not a good entry point.
Greg Staples, Matt Miskin, to the two of you, thank you. Appreciate catching up. Thank you very much. Equity futures right now down 0.9% on the S&P 500. A whole lot softer this morning. In the bond market, your 10-year, the yield unchanged on a 10-year in the Treasury market, 368 at the front end. Yields just a little bit higher on a 2-year, 446, call it 447. And 2s, 10s pushing negative 80 basis points, negative about 77, negative 78 at the moment. Coming up, the morning calls, and later, Chairman Powell delivering his final remarks ahead of the December rate decision. That conversation just around the corner. 5 minutes away from the opening bell this morning. Good morning to you all. Your Monday morning price action looks like this. Down about 0.9% on the S&P, on the Nasdaq. Down about 0.75%. That's the price action. Let's get you some morning calls. First up, JP Morgan upgrading Wynn Resorts to overweight, expecting China's economic reopening, if it happens, to fuel a rally in casino stocks next year. That stock is positive by more than 5%. Up next, Barclays downgrading Tyson Foods to underweight, saying protein companies face a difficult outlook as consumers spend less and prices keep rising. That stock is down by more than 2%. And finally, Morgan Stanley downgrading Williams-Sonoma to underweight, expecting negative earnings revisions amid weakening demand. That stock is negative by, let's call it, 3.9%. Coming up, US shoppers kicking off the holiday season with a muted Black Friday. That conversation up next with Crossmark's Victoria Fernandez. That conversation just around the corner, together with the opening bell, with equity futures down 0.9% from New York. This is Bloomberg. 24 seconds away from the opening bell this morning. Good morning to you all. Equity futures negative through most of this morning. We're down by 0.8% on the S&P 500. On the Nasdaq, we're down by 0.7% on the Russell, the small caps, down by about 0.75% also. Coming off the back of a week of gains on the S&P 500 and looking to close November with a month of gains over the next couple of days as well. There's the opening bell. Switch at the board and get to the bond market. Yields look like this on a 10-year, unchanged at 368.30. At the front end, 2-year yields just a little bit higher through much of this morning. 2s, 10s very close to negative 80 basis points. The euro 104.38, positive 0.4%. One ECB speaker earlier on today said talk of over tightening right now is a joke. We'll get into a conversation with Mike McKee later as to whether that's a joke or not for the Federal Reserve. The holiday season very much underway. The shopping picking up over the last couple of days. Abigail Doolittle has more on that. Hey, Abby.
Hey, John. Well, early signs are certainly not great about holiday shopping 2022. Before taking a look at some of those more traditional names, let's take a look at two of the indirect holiday names. Also, why the markets are down so much. Apple and Tesla. And of course, Apple down in part on the China tumult and that exclusive reporting by Bloomberg that there could be a default or a shortage, I should say, of 6 million iPhones. And you were talking about demand versus supply. I would say it's also supply, because I have tried at a number of stores in this area to buy one, and you just simply can't get them, not even the Pro, just the regulars. And Tesla, of course, 25% of its revenue coming from the China area. So folks may be not buying their iPhones and Teslas this holiday season or have a problem buying them. As for some of those more traditional names, the retail sales picture, not great, although we have a little bit of a uptick there for Walmart, not surprisingly, one of the staple stocks that is higher on the year. But Black Friday sales, according to Retail Dive, rose by 2.3%. Online sales by just about the most. BI channel checks, John, indicating that the U.S. Northeast had better crowds than other areas. But both Macy's and Kohl's talking about the fact that opening traffic for their stores down by about 3/4 to later in the day. So again, channel checks, muted action for this holiday season so far.
Is Cyber Monday actually a thing, Gabby?
For me, not so much. I am definitely a bricks and mortar person, so I can't speak to it. But it looks like that growth this year, John, just about 2.9%. When you account for inflation, not very much at all.
Abby, thank you. Abby with the stats this morning. About 2 minutes into the session, equities down by 0.6%. Staples outperforming, unchanged. Energy underperforming. Crude getting hammered. Crude's come down from the low 90s to the low 70s in just a couple of weeks. Just a monster move through November. Huge range of about $20 or so. Energy this morning. Energy equities down by almost 3%, negative by 2.95%. Cyber Monday then, testing the U.S. consumers' resilience.
Consumers have delivered this year.
This is an interesting year.
Consumer sentiment is at a record low. We have had a very steady pace in terms of overall spending, and the labor market is great.
There's still a lot of pent-up savings. There's still a lot of liquidity in bank accounts.
People, when they have income, they spend it. Americans have income.
Most retailers expect it to be a sort of subdued holiday season, not a disaster, but a more promotional holiday season.
And honestly, I'm not too worried about some of these businesses, the big businesses, taking a little bit less in profit.
Investors keeping a close eye on profit margins amid mounting economic concerns. Crossmark's Victoria Fernandez writing the following: inversion of 3-month and 10-year yields leads us to believe we are more likely to have a recession in 2023, but it should be mild as both household and corporate balance sheets remain decent. Victoria, I'm pleased to say, joins us right now. It's a question we've asked for a number of months, Victoria, and it's great to catch up with you again. Just how resilient is the US consumer?
Yeah, I mean, look, you and I have talked about this numerous times this year, and I am of the strong belief that the consumer is stronger than a lot of people think it is. There is a dichotomy, right, between a higher-end consumer and a more average consumer. We are seeing that. Some of the more luxury items, luxury goods, sales are a little bit better. We have seen the higher end consumer actually come down a little bit from their usual spending, shopping at places like Walmart, but the spending is still there. This is going to be the foundation, I think, that we have leading into next year, that I think we will have a recession. The 3-month to 10-year tells you that, because now we're inverted, I think, a little over 60 basis points there. But the balance sheets of both the consumer and corporations at this point in time is going to hold us to not have a very steep recession.
Victoria, when it comes to headlines on spending that we've all seen over the weekend and through this morning as well, what's more instructive to you, value or volume?
Well, I think it's going to be a combination. And look, I know the numbers were not as strong on Black Friday as a lot of people thought they would be. Some of that, I mean, for my household, we stayed home until late because we were watching the World Cup game, U.S. versus England. We didn't even hit the mall until around 4 or 5 o'clock in the evening. So perhaps there were some things going on that people didn't go out quite as often. I think today will be an interesting time, Cyber Monday. Let's see what kind of sales are there. Let's see what kind of promotions we're getting. But there weren't a tremendous amount of those doorbuster deals that a lot of people were waiting on. So your ticket items are going to be a higher price, which means the sales themselves will be higher. I'm not sure volume will be as much. And that's going to come down to those companies then that have the pricing margins and the pricing power. They're the ones that will do well this season.
Victoria, are you seeing signs of borrowing picking up to maintain some of this spending?
Well, we obviously see credit card usage going higher. It's getting closer to what we consider those pre-pandemic levels of where they are. The balance of the debt on their credit cards versus their total debt limit is moving higher. But again, higher than where we were the last 2 years. So many people had paid down their debts with some of their stimulus payments that the consumer were in such good shape, they had room to build up some of this revolving credit. So we are seeing that. I think it's something we have to continue to watch. We're not extremely worried about it at this point in time, but let's see what happens over the holiday season.
And Mike McKee, this will be on the Fed's radar, that's for sure. We hear from Chairman Powell on Wednesday.
Yeah, this is a very busy week, John, for everybody. A lot of data, and it is one of those rare weeks where the big number of the week jobs is going to be overshadowed by the Fed, by Jay Powell on Wednesday. You take a look at what's going on Wednesday, not just Powell, but jolts. So he'll be talking about the labor market. And the question we're going to have is, which Jay Powell do the markets get? Do they get the one who came out on November 2nd at the end of the last Fed meeting and was very hawkish? At least that's how his remarks were interpreted. Interest rates going higher than expected, a ways to go, too premature to think about pausing. Or do we get kind of the Fed speak that we got out of the minutes last week? An increase would be a danger here. A slowing in the pace of increase may be appropriate. Policy tightening could raise risks. We're going to have to wait and see what we get from him, but probably he's going to lay the predicate for a 50 basis point move. Now, he is talking about employment, and it is employment week, so it's going to be interesting to see what he has to say about this. And I want you all to pay attention to this. Take a look at when the Fed is raising rates, which is the white line, and unemployment. Usually, unemployment does not start to really go up until the Fed has almost finished raising rates. And we have not seen unemployment go up. It's a lagging indicator. So we'll see what we get on Friday. We're at 3.7% right now. But do we start to see the same kind of reaction we've had in the past, or is this truly a different time, John?
Mike, I wonder if you're on the same page of Andrew Honenhorst over at Citi. This is what he had to say this morning. Base case would be that Powell would guide a well-expected slowdown to a 50 basis point hike. But he went on to say, remaining hawkish by downplaying 1 month of softer inflation data, the jobs numbers may serve to emphasise his hawkish focus on a tight labour market. Mike, what do you make of that last line?
Well, I think that's extremely possible. It's a little early to look at the consensus forecast of economists for jobs because we get all that data this week, but it's about 200,000 right now, which is roughly where we've been. And as I mentioned, unemployment hasn't gone up. So the labor market is stronger than people have thought it would be. Now, maybe it's just delayed, or maybe this is a different time, but it could reinforce some kind of hawkish message.
Mike McKee, thank you, sir. As always, Victoria Fernandez back with us. Victoria, is it a different time in this labour market, or is that weakness just slightly delayed?
Well, I do think it's going to be a little bit delayed, but I think Powell is going to come out this week. And look, I think he agrees with the market, Jonathan, on a couple of things. He's going to agree with the market that the terminal rate is going to be higher than where it was at the September meeting, probably have a 5 handle on it or right at 5%. He's going to agree with the market that the December rate hike should be about 50 basis points. I think where he's going to disagree with the market and really push back is when it comes to the rate cuts that the market is pricing in for next year. And part of that is because the labor market is as strong as it is right now. Obviously, we have to wait for the lag effects of previous hikes to work their way through, and it is a lagging indicator, as Mike mentioned, but I think he's going to use that as a reason to tell the market, look, don't expect these cuts that are priced in. We're going to stay higher for longer, and that's going to be his pushback against the market.
Victoria, are we witnessing, though, maybe experiencing a period of time where the effectiveness, the power of that Fed speak is declining, has been eroded? Markets don't seem to be paying attention in the same way they have done.
Yeah, there's, a lack of confidence, I think, over the last year and a half that has developed in regards to the Federal Reserve. I mean, obviously, it all started with the transitory comments and things moving on from there and showing that that wasn't exactly what happened. So there is this lack of confidence in the Fed. And I think the market is saying, look, we have somewhat driven the Fed with what we're doing. Loosening financial conditions based on what they think the Fed ought to do has driven some actions by the Fed over the last couple of years. I think what Powell is trying to do here is say, we're not going to do that anymore. We are standing firm based on what we think is going to happen. Obviously, it can change with the data, and there's a lot of that coming. But I think the market feels like it has a little bit of power here, and it's trying to use it.
Hey, Victoria, wonderful to catch up, as always. Victoria Fernandez there. I want to check in on the euro just briefly. Euro dollar right now off session highs, positive 0.4% at 104.33. Something we've talked about in this programme a few times over the last couple of weeks. Just the sequencing here in the United States. We have arguably seen a peak of inflation before the economy has rolled over. In Europe, maybe it's the opposite. You can make the argument the economy is rolling over before we've seen peak inflation. ECB President Christine Lagarde just moments ago, I wouldn't go as far as saying inflation has peaked. The following headline, risk to inflation and the outlook are on the upside. Remember, the next ECB decision is on December the 15th, the day after the Federal Reserve's last decision of the year. We'll get back to that story a little bit later, no doubt, on Bloomberg TV and on Bloomberg Radio. Coming up, the US easing oil sanctions against Venezuela.
Is this oil that's already on the market just on the black market? Or is production actually going to increase in Venezuela, in which case that could be meaningful for the market?
The nuances of that conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Shopify president Harley Finkelstein. That conversation at 11:30 a.m. in New York, 4:30 p.m. in London. This is Bloomberg.
I do think that we're short on detail here in terms of the Chevron story. So, for example, is this oil that's already on the market just on the black market? Or is production actually going to increase in Venezuela, in which case that could be meaningful for the market, but probably is going to take quite a long time to actually get going.
The Biden administration giving Chevron the green light to resume oil production in Venezuela, a move that could add supply to the global oil market and ease price pressures at the pump. This as crude plunges to its lowest level since 2021. Joining us now is Bloomberg's Dan Flatley, joins us from D.C. Dan, can you walk us through the significance of this move from the administration?
Sure. So this is a move that's sort of been teased in various aspects over the last several months, something that we've been expecting, although there hasn't been confirmation, obviously, until over the weekend. What we know is that this gives Chevron a limited period of time to do maintenance on its projects in Venezuela and potentially move some product to the U.S., though that will be in a very limited capacity. And all this is predicated on what will happen in the talks between Maduro and the opposition party in Mexico City. So if you read the general license from Treasury and you look at some of the comments from lawmakers here in the U.S., this is sort of a very short timeline designed to give the Maduro regime, the Maduro administration, an opportunity to move forward with those talks. But the statement from the Senate Foreign Relations Committee Chairman Bob Menendez coming out shortly after the announcement was made on Saturday sort of lays out the stakes here. So if there is no progress made, this could be potentially reversed in the coming months, and the Office of Foreign Assets Control, which oversees sanctions for the U.S., has shown a willingness to reverse these sorts of decisions in the past. So there's still a lot of developments to come on the political front with this decision.
Well, it sounds like you think there could be scope. There's potential here for this to become something much, much bigger. In the near term, though, just going through the details of our story, in 2020, before the US ordered a complete halt of drilling operations, Chevron's share of Venezuelan crude production was 15,000 barrels a day. Now, for people who are not familiar with the oil market, that's less than the production of a single oil field in the Permian. So, Dan, just how significant is the current decision? How should I be thinking about it?
I would think of this as sort of a near-term decision, something that will, as the previous commentator said, take some time to come online if it indeed moves forward. But I think that there's still a lot of political risk here. If you look back at the history of this decision and whether it was going to be made or not, there was a lot of opposition, especially from Democratic lawmakers and the Florida delegation. And so I mentioned Senator Menendez's statement earlier, and that sort of gives you a sense of where this is likely going. But there's still some significant political risk here in that this decision could be reversed. And whether or not it has any material impact on the price of oil going forward is sort of a matter of I would say optimism at this point rather than what we know could or could not happen going forward.
Dan, appreciate the framing. Really do. Fantastic. Dan Flatley there of Bloomberg down in DC. Crude this morning on WTI down about 2%, down 1.9 to $74.80. Looking ahead, over the last couple of weeks, global credit markets have been rallying along with global equity markets. With the view for the year ahead, I'm pleased to say that joining us now is Oaktree's head of performing credit, Armen Panossian. Armen, fantastic to catch up with you, sir. We've had this tightening in credit spreads. I've had other people push back to me and say, we're going to get wider spreads. We're going into a downturn. Be patient. Don't go now. Wait for later. What do you say back to them?
Well, thank you for having me on, Jonathan. We are seeing some cracks in the economy. And so I would expect some credit spread widening as we enter 2023. We are seeing the impacts of commodity inflation, labor cost inflation, some demand destruction as companies try to pass through cost increases to their customers. So I would expect that there would be some continued volatility around credit spreads. But with that said, there are some bargains to be had. It is a credit picker's market, and we are seeing some very attractive situations in terms of dollar prices that are available in the market and absolute yields that are available in the market for companies that won't experience defaults or losses. So it is an opportunity as well as a risk, and one must tread carefully.
Where are you finding those opportunities? Could you be more specific?
Generally speaking, higher quality, high yield bonds offer attractive opportunities. The percentage of BB rated high yield bonds is the highest it's been in 10 years, with about 60% of the market being lightly levered and offering an attractive return, with dollar prices on those instruments in the 70s and 80s. In addition, private credit, certain types of private credit markets are experiencing dislocation, given the banks having stepped away from large cap direct lending to leverage buyout sponsors. So there is a widening in the pricing that we're seeing in direct lending, as well as a tightening in the legal protections that are available in direct lending.
It's a buyer's market, that's for sure, and that's a change from what we saw in the last decade. And you mentioned the improving quality of the high yield index, and many people on the same page, we all see the same thing. With that in mind, Armen, can you tell me how you think the index will perform in a downturn relative to how that index has performed in the past?
It's a great question. I think that the index is already predicting some level of a recession. Spreads generally are wide, or on the wide end of normal. Typically, high yield bond spreads are between 300 and 500 basis points. Today, we're on the wider end of that range, which suggests that there's an expectation of some level of risk and default as we head into 2023. So long story short is that some of the risk is already priced in, but I would expect that at some point next year, as we lap tough comps or easy comps in 2022, that we will see improved performance in the back half of 2023 and into 24. And so I think the market, in anticipation of that type of improvement, will likely be ahead of the fundamentals. And I think actually by the time 2023 and 2024 are over, they will be very strong years in terms of index performance. But obviously this year it's been a challenging year for high yield.
Can I work through just the following with you? So we've seen the bulk of the tightening cycle. You've indicated we've started to see the consequence of that. People started to price in the downturn. Can you tell me something, Armen? And this is where I'm really interested. When does the maturity wall start to become a problem? It's certainly not next year. But if the Fed is sticking with this high for longer story, we've had the higher rate story. Let's talk about the longer piece of it. Armen, when does that start to become a problem? Where is that maturity wall on the horizon?
It's really 2027, 2028. If you look at the maturity schedule for high yield bonds, only 6% of that market matures between now and the end of 2024. In the case of broadly syndicated loans, it's a little bit higher. It's about 8.5%, but still quite manageable. But if you were to really dig deep into what subsections or what ratings categories are spread across that maturity profile, it's really the triple C's and lower rated securities that are maturing in the near term. And therefore, there will be some level of defaults, but the percentage of triple C's in the market is quite low right now. It's under 10%. So I don't think that there is going to be a maturity-driven default experience in the next 2 years. The maturity wall is substantially extended at this point, and I don't think that we will see defaults driven by maturities. However, with floating rate borrowers in the broadly syndicated loan space, or even in the private credit space, especially in highly levered transactions with LBO sponsors, we will see some level of defaults and losses associated with those credits because they were very aggressively capitalized over the last 2 or 3 years, and they have the added cost of higher cost of borrowing with floating rates rising as rapidly as they have in the last 12 to 24 months.
Armin, this was a clinic. We appreciate it, sir. And let's have a longer conversation next time. That was Armin Panossian there on the credit market. Just to get back to the equity market, about 23 minutes in, equity's down 0.5% on the S&P. On the Nasdaq, we're down about 0.25%. Coming up, the market moving events you need to be watching, the trading diary for the rest of this week. From New York, this is Bloomberg.